$200 per barrel. I need you to stop whatever you are doing right now and think about what that number actually means for your life. Not for oil companies, not for traders on Wall Street, for you, for your gas tank, for your grocery bill, for the mortgage payment you are trying to keep up with, for the retirement account you have spent years building. Because in 2026, the conditions that could push oil to $200 a barrel are not a fringe prediction from a doomer on the internet. They are being modeled right now by Goldman Sachs, by the IMF, and by the energy desks of every major central bank on Earth. Stay with me for the next 10 minutes, because by the end of this video, you are going to understand exactly what $200 oil does to every corner of your financial life, and exactly what to do about it right now. Let me start with where we actually are right now, because you cannot understand where $200 oil comes from without understanding the current landscape. As of early 2026, crude oil has been trading in a range of roughly $80 to $95 per barrel. That is not cheap. It is not the crisis level of the 2022 spike when Brent crude briefly touched $130 per barrel following Russia's invasion of Ukraine, but it is elevated. It is elevated in an environment where global demand for oil is running at approximately 103 million barrels per day, a record, while OPEC+, the production alliance led by Saudi Arabia and Russia, has been managing supply with deliberate strategic discipline to keep prices in a range that maximizes their revenue without triggering the kind of demand destruction that pushes consumers toward alternatives faster. So the baseline is already tight. The buffer between current prices and a supply shock that pushes us toward $200 is thinner than most people realize, and the triggers that could close that gap are not hypothetical. They are active, they are documented, and in 2026, there are more of them simultaneously present than at almost any point in modern energy market history. Let me walk you through the specific triggers that analysts are watching in 2026. The first and most immediately alarming is the Strait of Hormuz. Approximately 20 to 21 million barrels of oil pass through the Strait of Hormuz every single day. That is roughly 20% of the entire world's daily oil consumption, moving through a waterway that is at its narrowest point only 33 kilometers wide. Iran controls the northern shore of that strait. The United States Fifth Fleet is based in Bahrain. In 2026, the relationship between Iran, the United States, and Israel is at one of its most volatile points in decades. Any military escalation in that region, a strike on Iranian nuclear facilities, an Iranian response targeting Gulf shipping, a blockade even for a matter of days, would send immediate shockwaves through the global oil market that make $130 oil look like the good old days. The second trigger is OPEC+ production strategy. Saudi Arabia, Russia, and their partners in the OPEC+ alliance have demonstrated in 2024 and 2025 that they are willing to accept lower production volumes to maintain higher prices. They have the fiscal discipline and the strategic alignment to hold that position. If demand continues growing, driven by India, Southeast Asia, and Africa, which are on steep industrialization trajectories, and OPEC+ keeps supply constrained, the simple arithmetic of supply and demand does the rest. The third trigger is what energy analysts call the investment gap. Between 2015 and 2023, the global oil industry dramatically reduced its investment in new production capacity, partly because of ESG pressure from investors, partly because of uncertainty about long-term demand as the energy transition accelerated, and partly because of the COVID-era destruction of cash flows. The consequences of that underinvestment are now showing up as limited spare production capacity. When a supply shock hits in an environment of limited spare capacity, there is no easy valve to open to make up the difference. Prices have nowhere to go but up. And here's the fourth trigger that brings all of this together in 2026 specifically. The U.S. Strategic Petroleum Reserve, the emergency oil stockpile that the United States government maintains specifically to buffer against supply shocks, was drawn down dramatically between 2021 and 2023, when the Biden administration released approximately 180 million barrels to try to cool gasoline prices. As of 2026, the SPR has only been partially refilled. The buffer that was supposed to protect against price spikes is thinner than it has been since the 1980s. If a supply shock hits and the US tries to respond with SPR releases, there is simply less ammunition available than there was during previous crises. Now let's get into what $200 oil actually does to your daily life, because I think a lot of people hear a big number like $200 per barrel and their brain kind of checks out. It feels abstract, like something that happens to oil traders and energy companies, not to them personally. So let me make this as concrete as I possibly can. The most immediate transmission channel is gasoline prices. The relationship between crude oil prices and retail gasoline prices is not perfectly linear. Refining costs, taxes, distribution margins, and local market factors all play a role. But as a rough rule of thumb, a sustained doubling of crude oil prices, from current levels around $90 to $200 per barrel, would roughly translate to retail gasoline prices moving from approximately $3.50 per gallon to somewhere between $6.50 and $8 per gallon in the United States, possibly higher in regions with higher state taxes or less refining capacity nearby. What does $7 gasoline mean in practice? For the average American who drives approximately 15,000 miles per year in a vehicle getting 28 miles per gallon, that's an additional $1,800 to $2,400 per year in fuel costs alone, just gone, on top of everything else. For lower-income households, which spend a disproportionately higher share of their income on transportation, the impact is even more severe. This is not a rounding error. This is a meaningful reduction in disposable income for tens of millions of families simultaneously. But gasoline is just the most visible transmission channel. Diesel is the one that matters more for the overall economy. Diesel is the fuel that moves trucks, trains, ships, and farm equipment. It's the energy source that underpins the entire logistics infrastructure of the global economy. When diesel prices spike, and at $200 crude, they would likely be above $8 per gallon, the cost of moving everything goes up. Every product on every shelf in every store has a transportation cost embedded in its price. That transportation cost gets repriced upward. Groceries. This is the one that hits people viscerally. Food prices are already elevated in 2026. The inflationary surge of 2021 to 2023 pushed grocery prices up significantly, and they haven't fully retreated. $200 oil adds multiple cost layers simultaneously: diesel for the trucks that move food, fertilizer that is a petroleum derivative and whose price tracks closely with energy costs, packaging that is largely petroleum-based plastic, and refrigeration costs that run on electricity partly generated from natural gas. Agricultural economists estimate that a sustained move to $200 oil could add 15 to 25% to food prices within 6 to 12 months, on top of an already elevated baseline. Airlines are one of the most direct casualties. Jet fuel accounts for approximately 20 to 30% of airline operating costs in a normal oil price environment. At $200 crude, jet fuel costs would roughly double or more. Airlines can't absorb that. They pass it through in the form of higher ticket prices, fuel surcharges, reduced route frequency, and in some cases, route cancellations for less profitable destinations. Business travel budgets get slashed, family vacation plans get repriced or canceled, and several smaller airlines, those without the scale, the hedging programs, or the balance sheet strength of the major carriers, face genuine existential questions about viability. And then there's the plastics and petrochemicals dimension that almost never gets discussed in mainstream coverage. Over 6,000 everyday products are made from petroleum derivatives, from the packaging around your food, to the synthetic fabrics in your clothes, to the components in your electronics, to pharmaceuticals, to medical devices. All of those products get more expensive when crude oil stays at $200 for an extended period. The inflation transmission from sustained high oil prices is broader, deeper, and more persistent than most people appreciate.
Let me take you back through history, because the best map for what $200 oil would look like is already written. We just need to read it. The year is 1973. OPEC nations cut off oil exports to the United States and several Western allies in October of that year, following the Yom Kippur War. Oil prices quadrupled in a matter of months, from about $3 per barrel to nearly $12 per barrel. In percentage terms, that is a bigger shock than what we are describing today. The consequences were devastating. Gasoline lines stretched for miles. The United States imposed speed limits, daylight saving time extensions, and odd-even rationing at gas stations. The stock market lost nearly 50% of its value between January 1973 and December 1974. Inflation exploded into double digits, and the recession that followed lasted years. Then, 1979. The Iranian Revolution removed approximately 4% of global oil supply, just 4% from the market. Oil prices doubled within a year. The second oil shock in less than a decade pushed U.S. inflation to nearly 14%. The Federal Reserve, under Paul Volcker, responded by raising interest rates to nearly 20%, deliberately triggering a severe recession to extinguish inflationary expectations. Unemployment rose above 10%. It was a brutal, painful, years-long adjustment. Now, here is what is different about 2026, and in some ways more dangerous than those historical episodes. In 1973 and 1979, the global economy was far less interconnected. Supply chains were more regional. Financial markets were less globally integrated. The transmission speed of an oil shock from the commodity market to the real economy was slower, measured in months rather than weeks. In 2026, the transmission is instantaneous. Futures markets reprice within seconds. Shipping freight rates adjust within days. Consumer prices begin moving within weeks. And because global financial markets are now wired together in ways that did not exist in 1973, the impact of a $200 oil scenario is not contained to the commodity sector. It transmits immediately to equity markets, to bond markets, to currency markets, to credit markets, all simultaneously, all at the speed of electronic trading. There is also an inflationary baseline problem that makes 2026 uniquely vulnerable. In 1973, the United States and most Western economies entered the oil shock from a position of relatively moderate inflation, though it was already rising. In 2026, central banks are still managing inflation that has not fully returned to target following the 2021 to 2023 inflationary surge. Core inflation in the United States is still running above the Fed's 2% target as of early 2026. An oil shock of the magnitude we are describing would hit an inflationary foundation that is already elevated, like throwing gasoline onto embers rather than onto cold ground. The risk of inflation re-accelerating dramatically is substantially higher than it was going into previous oil shock episodes. And one more crucial historical lesson. The 2008 oil spike, when crude oil hit nearly $147 per barrel in July 2008, contributed meaningfully to the economic stress that preceded the financial crisis. Economists debate exactly how much the oil spike contributed versus the housing market collapse, but the data is clear. The combination of $147 oil and a stressed financial system created a more severe economic contraction than either factor alone would have produced. In 2026, with regional banking stress, elevated government debt, commercial real estate under pressure, and a shadow banking sector carrying systemic risk, the combination of $200 oil and an already stressed financial system is a scenario that deserves serious preparation. All right, here is what you actually do, because understanding a risk without taking action on it is just sophisticated worry. And I am not here to make you worry, I'm here to make you prepared. Before I go through this, the standard and entirely genuine disclosure, I am not a licensed financial advisor. Nothing here is personalized financial advice. Your specific situation requires a conversation with a qualified professional. What I'm giving you is a framework based on how institutional investors and serious portfolio managers think about oil price shock scenarios. Take it, do your own research, and make your own informed decisions. The first thing you need to understand is your direct energy exposure in your investment portfolio. If you own broad equity index funds, which most everyday investors do through their 401k or retirement accounts, you already have some exposure to energy companies through the S&P 500's energy sector weighting, which represents approximately 4 to 5% of the index in 2026. In a $200 oil scenario, that weighting performs extremely well. Integrated oil majors like ExxonMobil, Chevron, Shell, and BP, companies that produce, refine, and sell oil, see their revenues and profits surge dramatically when oil prices spike. Their stocks typically outperform the broader market significantly in oil shock scenarios. In 2022, the S&P 500 energy sector was up over 60% in a year when the broader S&P 500 was down nearly 20%. In a $200 oil scenario, those moves would likely be even more dramatic. The question is whether your current allocation to energy is sufficient given your view on the risk. Most standard index fund investors are passively exposed at the market weight level, around 4 to 5%. Some investors in 2026 are deliberately overweighting energy, moving to 10, 12, or even 15% energy allocation as an explicit hedge against the oil shock scenarios we have been discussing. Whether that makes sense for you depends on your overall portfolio, your risk tolerance, and your time horizon. But understanding that energy is the natural hedge against oil price risk is the starting point. Second, think about commodity producers more broadly. $200 oil doesn't exist in isolation. It typically occurs alongside elevated prices for other commodities, natural gas, copper, agricultural commodities, because the underlying drivers of oil price spikes often affect other commodities simultaneously. Higher oil prices raise production costs for almost everything, pushing up prices across the commodity complex. ETFs that provide broad commodity exposure, like commodity index funds, tend to perform well in sustained high oil price environments. Third, gold. Gold deserves specific attention in the $200 oil scenario because oil price spikes of this magnitude are deeply inflationary, and gold is, over long periods of time and across many different economic environments, one of the most reliable inflation hedges available to individual investors. In 2026, gold is already trading above $3,000 per ounce, reflecting existing geopolitical anxiety and inflation premium. In a $200 oil scenario that triggers a significant inflation resurgence, gold could move substantially higher. A meaningful allocation to gold through physical gold, gold ETFs like GLD or IAU, or gold mining stocks for a higher return, higher volatility play makes sense as part of a portfolio designed to be resilient in oil shock scenarios.
Fourth, look seriously at Treasury inflation-protected securities, known as TIPS. TIPS are U.S. government bonds whose principal value adjusts upward with the Consumer Price Index. If $200 oil triggers a significant CPI resurgence, which, based on historical precedent, it almost certainly would, TIPS holders benefit directly from that inflation adjustment. They are not the most exciting investment, they do not go viral on financial social media, but in a scenario where inflation re-accelerates sharply, they perform exactly the function they are designed to perform. They protect the real purchasing power of your fixed income allocation. Fifth, and this one is about personal financial resilience rather than portfolio construction, revisit your budget and your fixed versus variable cost structure. $200 oil means higher gasoline prices, higher grocery prices, higher utility costs, higher costs for almost everything. If your monthly budget is already tight, an oil shock of this magnitude creates real financial stress. The most powerful thing you can do right now, before the shock arrives, not after, is to build your cash buffer. Lock in fixed-rate debt where you have variable rate exposure, and identify where in your personal spending the most significant oil price-sensitive costs sit. Forewarned is forearmed. You cannot control the oil price. You can control your financial resilience when it spikes. Let me give you the big picture context that I think is essential for thinking about this correctly. The $200 oil scenario is not just a price event, it is a signal about a fundamental tension in the global economy of 2026 that is not going away anytime soon. The world is attempting the most ambitious energy transition in human history, moving away from fossil fuels toward renewable energy sources as the primary driver of economic activity. That transition is real. It is accelerating. The growth in solar and wind capacity, in battery storage, in electric vehicle adoption, these are genuine, significant developments, and they are creating a long-term trajectory toward reduced oil dependency. But here is the critical tension. The transition is not happening fast enough to reduce current oil dependency significantly. In 2026, the world still needs 103 million barrels of oil per day. Electric vehicles represent roughly 18% of new vehicle sales globally as of 2026, a remarkable increase from near zero a decade ago. But the existing fleet of 1.4 billion gasoline and diesel vehicles is not being replaced overnight. The infrastructure of the global economy, ships, planes, manufacturing, agriculture, plastics production, is still almost entirely dependent on petroleum. The energy transition is real, the dependency is also real, and the gap between those two realities is exactly where the oil price risk lives. That gap between a world that is trying to transition away from oil and a world that still needs 103 million barrels of oil per day creates a peculiar and dangerous investment dynamic. On one hand, reduced long-term investment in new oil production capacity because investors expect declining long-term demand. On the other hand, sustained high short-term demand because the transition is taking decades, not years. The result is a market that is chronically underinvested in supply relative to near-term demand, which is exactly the condition that produces price spikes when any disruption occurs. Understanding this dynamic is not just important for understanding the $200 oil scenario, it is important for understanding the energy investment landscape for the rest of this decade. The companies that are threading this needle, producing oil efficiently and profitably at current prices while also investing in transition energy capabilities, are the ones that sophisticated energy investors are watching most carefully in 2026. Here is where we land. $200 oil is not guaranteed, but it is not a fantasy either. The conditions that could produce it, Strait of Hormuz tension, OPEC plus supply discipline, underinvestment in new production capacity, a depleted U.S. strategic petroleum reserve, and an already elevated inflationary baseline are all simultaneously present in 2026 in a way that makes this scenario genuinely more plausible than at almost any point in the past decade. And if it happens, the consequences reach into your gas tank, your grocery bill, your investment portfolio, and the broader economic environment within weeks. History is clear about what oil shocks do. The 1973 and 1979 episodes wiped out decades of stock market gains and took years to recover from. The 2008 spike contributed to the worst financial crisis since the Great Depression. $200 oil in 2026, hitting a financial system that already carries significant stress, would be a defining economic event of this generation. The right response is not panic, it is preparation. Understand your energy exposure, build your inflation-resistant portfolio layer, maintain your personal financial liquidity, and stay informed about the geopolitical triggers that could make this scenario real. You have done more of that preparation in the last 10 minutes than most people with money in markets will do all year. That matters. Use it. Drop a comment below. What do you think is the most likely trigger that pushes oil toward $200 in 2026? The Strait of Hormuz? An OPEC plus surprise production cut? A broader geopolitical escalation? I genuinely want to know your read on this. I read every comment. If this video gave you something real, something that changes how you think about your money and your portfolio, hit that like button. One click helps this reach more people who need this information. And if you're not subscribed yet, I'll be straight with you. This channel delivers the kind of financial intelligence briefings that serious investors use to stay ahead of risks that most people only understand after they've already been hurt. Subscribe, turn on notifications, and share this with one person in your life who has money invested and has never thought seriously about oil price risk. You know someone who should see this. Coming up very soon, we're breaking down what happens to the U.S. housing market specifically if inflation re-accelerates in 2026. Not the stock market, the housing market. Mortgage rates, home prices, rental markets, all of it. That one is going to matter directly and personally to a lot of you. Do not miss it. I'll see you there.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.